Hello, everyone. Thank you so much for joining this episode of the On the Mark podcast and financial forum. We have a great guest today, Brad Tisdale of Tisdale Insurance Services. Brad, thank you so much for joining us. And why don't you introduce yourself to the group?
Sure, my pleasure. Again, my name is Brad Tisdale, and I have my own practice called Tisdale Insurance Services that I've had for about 30 years. And I help people protect what's important to them, working with individuals and business owners, helping them protect their wealth and their income, and of course, their family. In the event that something happens to them, they live too long, die too soon, or get sick or injured along the way, just make sure that they have the financial liquidity to make sure that the family's taken care of and they can maintain their lifestyle as much as possible from a financial standpoint.
That's great. And I think one of the issues that we're seeing often is that not an issue, it's really a beautiful thing. People are living longer than they used to. So
Hmm.
long-term care, as a result, the longer you need it, the more expensive it is, obviously, as you pay for it over time. But what sort of trends have you been seeing in your space? Like, are people underinsuring because they're trying to cut costs? Like, what are the issues that you see?
So perhaps we can just kind of drop back and talk about when we mention those terms, long-term care, what actually are we talking about? So to give us some context here, and one of the things that I do because I'm contacted by people every day that want information about long-term care plans, long-term care insurance. And one of the things I ask them really is two things. Is one, what prompted you to look into this? And oftentimes they share a story about a parent or a spouse that's something's happened to them and now they need care, home care or facility care, something like that. But I always ask them, well, when you think of long-term care, and we're kind of having this discussion, what image comes to mind? And the majority of the people think that, well, yeah, well, this is something that happens at the very end of my life. As you mentioned, Mark, we're living longer. And maybe that's when someone's in their late 80s, maybe 90s, and they're in a nursing home because they've got dementia or they've had a massive stroke, for example. But long-term care, it's really not a place, it's an event. And it's an event that is, when it hits, it's pretty involved emotionally, financially, physical in terms of what caregiving is. But one of the reasons I ask the people, what comes to mind when you think about long-term care because they think of something extreme, but it's actually, Mark, it's something that can happen to anybody at any age. There's nothing in the definition of long-term care that says, oh, I've got to be 90 and in a nursing home. In fact, 40%, two out of every five people who actually need care are under the age of 65. Does
Wow,
that surprise you?
it does, yes.
And
And kind of
do you know what
terrifies
it's
me at the same time.
from?
Tell me.
Accidents. Oftentimes it can be an accident or an injury or an illness, and accident in the home or a recreational accident or a car accident. So, say for example, I get in a car accident and I die, well, I have life insurance to protect my family. But if I get in that same car accident and I'm paralyzed or I've got a significant brain injury and I can't take care of myself either physically or cognitively, that's a long-term care event. And so now it can be, of course, just a result of just normal aging and frailty. As you mentioned, people are living longer. And so like one of the questions I ask is it possible that you could live, you're healthy, you're 60 and healthy. Could you live a relatively long life? And they say, yeah, I hope to. Well, is it also possible that at some point you might just become frail and need care over a period of years? Or maybe your frailty is cognitively, mentally, and you're just not able to take care of yourself. Yeah. And so, what would that look like physically, financially, or emotionally to your family if they had to take care of you? So, it can be just normal aging and frailty as well, or just an accident, injury, or illness. So it's kind of a broad spectrum in terms of what it is and who needs it.
Yeah, and I think you're right. I think it is kind of surprising to think of it that way, but it makes sense. And one of the questions that we get from people that ask about this type of insurance that I've heard asked before is what's the difference between this and like a disability policy? Would a disability policy cover you if you had an accident, or is that something
Yeah. So, what a disability policy is to do is that's income protection or paycheck protection. And so what that means, and oftentimes people through their workplace have a disability policy. And so what that means, if they get sick or injured and are no longer able to work and earn an income, they have a disability policy that's going to replace the income that they're no longer able to earn. And so that just helps them make sure they can pay their bills, they can pay their mortgage, they can buy groceries, they can pay the light bill, other utilities, because they're going to have that income coming in. So oftentimes when we're talking about that type of coverage, I'll ask people to say, "What's your greatest asset?" And they say, "Oh, it's my home or it's my 401k." No, it's your ability to work and earn income. If you lose that due to accident or illness, are you covered? And that's what a disability policy, it replaces that income. So I'll tell you a story. I had a client through his workplace. We did a group disability policy and long-term care. Now he was 59 years old and then suffered a brain tumor. And because of that brain tumor, he couldn't work in his occupation anymore. So now he's not working, but the disability policy paid, gave him income every month so he and his family could live on. But at the same time, his wife was still working and she needed to go to work every day. He couldn't stay home alone. And so they needed a caregiver. And his long-term care policy paid for that caregiver to help him every day with meal preparation, help him just really supervise him throughout the day because he really just was not in a space cognitively where he could stay home independently without maybe being a danger to himself. He could, if something happened, he wouldn't know what to do. So he needed a caregiver just to be with him day after day. And his long-term care policy paid for that. And his wife said, if we didn't have these two coverages, we would be up a creek was kind of the word that she used.
Right. Well, and we see a lot of people that have disability policies, maybe through their work, or maybe they have a private policy, but having that without a long-term care policy is almost like covering yourself for one potential issue but not another. It seems like almost
Yeah,
counterintuitive, like you're leaving a huge hole in your protection plan if you do that.
yeah, and a lot of people who you work for a company have the decent group benefits that cover that. It's really if you get in those self-employed individuals that if they don't have that, they have a private practice, whether it's trades or in the legal or financial or whatever, and they don't have an individual policy, then they should definitely take a look at getting something like that.
Yeah. And aren't some of the employer policies a little bit limited? Do you generally recommend that people, maybe not self-employed people, let's just say it's people that are employed by some medium-sized corporation, let's just say, are those policies usually insufficient for the type of coverage that most people would typically want or need?
On the long-term care side,
Yeah, sure.
yeah, on the long-term care side, if they're just kind of putting it in as kind of a blanket plan that covers everybody and there's not a whole lot of customization because you're putting it over everybody's getting the same thing. And to keep the cost down, oftentimes it's not really that much coverage.
Right.
And I run into some people that do have through their employer a certain amount of coverage and they always want to upgrade it. They always want to add to it just to supplement what they have through their employer. But most of the time you're running across people that have no long-term care insurance at all and they're just 100% exposed to this financial risk and they really don't understand what it is and think about it until suddenly there's an event in their own family and then the lights go on. They're like, oh my gosh, how do people handle this? How do people pay for this? And it's a real wake up call.
And by the time you're aging, let's say you're in your 70s, it's almost too late to get one of these policies, right? You kind of need to get them.
Yeah, it can be. And, I mentioned earlier, under age 65 is about who needs care. It's about 2 out of 5 people needing care under age 65. But once someone's over age 65, there's about a 70% chance they're going to need care at before the end of their lives. A little bit higher for women, a little bit less for men, but yeah, there's a high probability that they will need care. And when it comes to care, okay, well, why do we look at insurance for that? Because it's expensive. Home care is expensive. Depending on where you live in the US, you can end up paying just for an hour of care for a caregiver to come in. It could be anywhere from 20 on the very low end to 50 on the high end. So you run that out. Well, and you'll say someone needs just an 8-hour shift, 30 days a month. You could look at anywhere from five to $12,000 a month just for a caregiver.
And that's just for
Not a
eight
whole.
hours. Last I checked,
Yeah,
the day is three times longer than that.
Yeah, and so if you need two shifts, and so when you're looking at assisted living or memory care or even nursing home, those dollar amounts can be somewhere in the same thing. $15,000 a month, again, depending on what the level of care you need and where you live. So most people, I mean, if they're in a situation where they're having to divert thousands of dollars each month for their care, is that going to cause an adverse impact on their finances or their living
Big-
situation? Yeah,
Yeah,
and so
it
when
would
when
definitely put a dent in my finances for sure.
yeah, and so when they get in that situation, what oftentimes they're surprised with is, how do people pay for this? And because Medicare and health insurance don't pay for it. Because what we're talking about is non-medical services when there's a caregiver coming in. So it's not, your doctor's not going to come in and help you bathe and dress and feed you breakfast and things like that, help with laundry and things that you normally do to stay home every day. So it's not covered by health insurance or Medicare. So people are either paying cash out of pocket for this month after month after month, or they have a long-term care policy. Those are the only two things that pay for it. So you were asking a question, as people get older, once they're older they get and the more health conditions they have, their options to get a long-term care policy become very limited. It's one of those policies you actually buy with your health, and then you budget for it monthly or annually in terms of paying that premium. So the younger and healthier you are when you get it, the more value you get from the dollar in a policy. The more cost effective it is. So
And tell me how it works. So you pay in, let's say it's a monthly figure, whatever that number is, I guess it doesn't really matter. But you pay in monthly, and then do you get a certain amount of benefit per month up to a certain age, or do you just accrue a certain amount of dollars that can then be used at your own discretion, or how does that work?
you're on the right track. And so what you're doing is when someone's buying a policy, there's a lot of ways to put these policies together. But essentially what they're buying is this big pool or big bucket of dollars. 100,000, 200, $300,000 of money that's sitting there. It's liquid, it's tax free when they're using it. And so instead of having to sell off an asset, invade retirement funds, or maybe sell some investments and end up with capital gains or something like that, they've got this pool of money that they're able to use up to a certain amount per month. And these are choices, all these benefits that we call in their policy. That's what we call them, they select them. So how much per month is this policy going to pay? And how long is it going to continue to pay? It's going to continue to pay out a monthly benefit to reimburse or pay for your long-term care expenses at home or in memory care or facility care like assisted living up until there's no more money in that policy. So those are really the two main things in a policy. Then the other thing they're looking at is when they're younger, they're buying a policy and those benefits they select initially, they're adding an inflation component to those. So year after year, as they continue to pay their premium year after year for their policy, benefits in their policy grow to make sure that 15, 20, 25 years down the road, the benefits in their policy have kept up with what the future cost of care is going to be. So they build in an inflation factor, a cost of living adjustment, for lack of a better term, into their policy. And so their pool of money grows, the amount of dollars in their policy grows, and their monthly benefit increases.
Right. And does
So
that
that's
pool of
kind of like a
money?
real basic
Yeah.
explanation, but
No, it makes a lot of sense. And so I'm always thinking about things from an investment standpoint. So when you're putting money into the policy and that's just growing because you're increasing the principal, what actually happens with that money? Is it somehow invested by the insurance company? Does it kind of like a 401k might be invested in certain stocks or other investments that grow over time? Or is it really just kind of like a cash account that might have interest on it that is accruing, based on inflation, or how does that work?
so initially you're leveraging your existing dollars to buy this big bucket of money for when you need care. It's just like any other insurance policy, for example. So you're paying your premium. When you need care, you know you've got X amount available to you at the time you need care. So the insurance company, they're collecting premiums from all the different insureds out there, and they, of course, have to take some of that premium they collect and put it inside for reserves, and the other premium they're using to invest and grow their overall portfolio. So they've got a substantial amount in order to meet the promises they've made to all the different insurance policy holders. So, so that first premium you pay, whether it's just that first month you pay one premium or you pay that premium for the year, it gets you your total amount of benefits in your policy. It's not like a savings account that
Got
you're
it.
having to pay into this and eventually get to that amount of benefits. It's like you're covered from day one. It's like life insurance. Figure out life insurance, for example. Someone has $1 million life insurance policy, and it might cost them for their life insurance policy, say $1,500 a year. It's not saving $1,500 a year, hopefully getting up to that $1 million of coverage. That first $1,500 premium, and they've got $1 million of coverage. If something happens to them, they're covered up to that amount.
Right. So
They're
it's
not
even
saving
if
for it.
something happens on day two after you bind the policy and sign all your documents, you're entitled to the full.
Yeah, you're covered.
Yeah. Okay.
Yeah.
Interesting. And what happens if you don't, for whatever reason, let's say the proverbial hit by a bus scenario, which hopefully never happens to anyone listening to this podcast, but you get hit by a bus and you don't make it, and you've paid your premiums into this, but then there's really no benefit paid out. Is it a kind of use it or lose it? Are there different options there?
It all depends on how you design the policy. So there are what we call traditional or standalone long-term care policies that you, for lack of a better term, can say use it or lose it. But that's no different than your automobile policy, your homeowner's policy. Gosh, you never had that major car wreck where a family sued you for $2 million. You were paying the premium to make sure you're covered if that event happened, but it never did. You got hit by a bus, you passed away, you're no longer driving. Well, so you obviously you don't need that policy anymore, but you were covered.
Right.
Same thing.
Got it.
There are other policies that allow you to structure it where, in the event something happens and you end up passing away, there's a death benefit that goes to your beneficiaries. So those are called linked benefit or hybrid long-term care plans. It's a long-term care solution, but oftentimes they're based on a life insurance chassis or an annuity chassis. And others are just pure insurance, like what we call a standalone policy. So there's a variety of different ways to put these policies together. And when I work with individuals, I'm always looking at they want a long-term care solution. They don't want to be right now, if something happens to them and they need care, they're 100% exposed. All they have to pay for it is what they've got in assets. And if they, what they have in income. If they don't have enough monthly income to cover that high cost, they start liquidating their assets. So they're 100% exposed. So if they're looking at a long-term care policy, what I do as a professional, I take a look at their age and their health, their financial situation, their family history, and their goals, what's important to them. As they look at the next 20, 30 years, what do they want to see happen? And what do they want to prevent or protect from happening by having this type of coverage in force? And then based on all the information they're giving me, then I can look at the market because I don't work with a specific insurance company. I work with the majority of the carriers out there, and I can help them customize and design something that's really going to fit their specific situation from a pricing standpoint, from a health underwriting standpoint. So about 80% of the time, we're able to find something that's affordable that they can health qualify for that's really going to give them the amount of coverage that they need. But there's always about maybe 20% of the folks that either due to their health or their age or even their financial situation where long-term care insurance just might not be a good fit for them.
Right. And so what is, just talking in general terms, I know this is an impossible question. It's the same as me getting the question, what's your rate, without knowing any information, which
So,
drives
so,
mortgage lenders
so you can
nuts.
ask me anyway.
Yeah, I'm going to do it anyway because I get to put you on the spot for once. It's not me on the other side of this question. But I'll give you a scenario and you could just give me a range. I'm not looking for an actual quote. Okay, I'm 46 years old, generally healthy, no major medical history or anything like that in the bloodlines or whatever. What would, for a sandwich generation person like myself, what would an average policy run? Are we talking $1,000 a month, couple $100 a month,
Yeah.
20,000 a
So
year? Like, Just
it's interesting
ballpark.
because I love a couple things. One, the term average. Well, what's you know what? Because
I'm average looking. How about that?
what average? What's average? You're taking a high and a low and trying to find somewhere in the middle. One guy explained that to me. It's like, hey, my head is on fire, but my feet are in a bucket of ice water. But right, my stomach feels okay, so
Yeah,
that's about
everything in the
average.
middle is
All
just
right. So,
even
but
keel.
the other thing is I got a long time. Someone says, well, how much for that bag of groceries? Well, it really depends what's in the bag.
It's in it.
So,
That's a good
but
touche.
all that being said, um, it, if you're buying like a policy that's going to pay, a decent amount of coverage to you for a certain period of time at your age, you could definitely get something probably pretty good at your age for probably anywhere from, on the low end, 100, maybe $300 a month if you wanted something big, something like really robust, or do you want something small? But one of the things is key is that uh, when designing the part of long-term care planning is when these plans are properly designed, they really need to be what I call custom tailored. And what I mean by that is you can either fully insure or you can co-insure. And fully insuring, that's the idea that when you need care, you could go to some really fancy facility and we've designed a long-term care policy to pay for every penny of that. And it's going to be an expensive policy. But for most people, that may not be necessary. For most people, the more optimal solution, and this is what I find a lot, is that the optimal solution is what we call co-insuring. And so co-insuring is the idea that when you need care, you may not be spending your income the same way you are when you're healthy. In other words, might not be traveling as much. You might not have as many extracurricular activities or outings, or you might not even be driving at that point. So there's a certain amount of your income that you can use to help pay for your care. And we really look at designing the insurance to cover that difference. So really my objective is to get a certain amount that they can comfortably afford that's going to allow them to have access, the financial resources to pay for quality care in the setting of their choice, but at the same time without having to start burning through and liquidating their assets and their savings. Really slow the burn rate on that. And so that looks different on everybody. And so that's why some people just send me quotes. Well, they're all custom tailored. It's not a one size fits all.
Right. Yeah, it's the same question I get, so I'll
Yeah. So
apologize to you
is that
for
how you
asking.
answer it? You know,
No, you answered better than I did. I like the
yeah,
bag
it's
of groceries analogy. If
yeah,
you
and,
don't mind,
and some people say, it's like having a car payment. Okay, well, what kind of car do you want to drive?
you could have a car payment of zero, or you could have a car payment of
Yeah, so
one
what,
time.
do you want to drive something really fancy and or you just want to have something that just gets you from point A to point B,
Right. Well,
you know?
ironically, all my clients, we try to remind them, don't buy that car right before you close on the house. 'Cause that happened a couple of times, and that caused some issues.
Yeah,
Not to
start
digress, but
financing their, yeah,
exactly. Wait to buy the car until you live in the nice house and need the Ferrari or the Porsche. Just wait,
yeah.
please. But okay, so let's say I get a average, sorry, policy. Let's say I'm paying $300 a month at 46. Does that premium go up over time as I get older, or are you kind of setting in what your monthly cost is at the beginning, and that's why it's better to start earlier?
Um, Again, it depends on the type of policy that you're getting. If you're getting a standalone policy or if you're getting a hybrid policy, the hybrid policies, those premiums are guaranteed never to increase. It's on a standalone policy, the premiums are designed to be level. And what I mean by that is the insurance company can never say, Mark, you got this when you're 46, but now that you're 65, your health is, you're a little older now. We better increase our rates on you. They can never do that. The only thing that can happen is if an insurance company, they look at a block of business, so like a number of policies that they wrote in a certain time period and or certain a group of policies that they wrote. And if they're experiencing more than anticipated claims on those policies, they can go to the Department of Insurance in their state and file for a rate increase for all the insureds. And if that's accepted, and here's the rate increase amount. Then they go back to the insured and say, yeah, we're increasing the rates on your policy. Here's some different options to consider to keep your rates the same. And then you work with the insurance company and or the agent to address that. So on older blocks of business, that has happened with some of the larger carriers. But in more recent blocks, they're always coming out, when I say they, the National Association of Insurance Commissioners, and looking at, and as well as the carriers and the underwriters, how can we design policies, price them effectively now so we don't have to have that future rate increase? So that's always a challenge from an underwriting standpoint and a regulatory standpoint. So
Yeah,
consumers are never
we're
put in
hearing
that
a lot
position.
about that commission also as it relates to homeowners insurance in California in particular after all the
Yeah.
wildfires this year.
Yeah, that's a whole. I'm not even gonna step into that one.
I don't blame you. It's a
So
big mess. It's a big mess.
yeah,
But the insurance companies are trying to make the same plea for governmental approval for pretty significant rate increases because they can't afford the losses that they've had. There've been so
yeah,
many claims in a short period of time,
yeah. And the key thing now with at least in the long-term care industry, especially on the standalone or the pure insurance policies, is that now there's been 30, 40 years of claims experience and better understanding of how many people keep their policies and the utilization of long-term care policies. They're doing a much better job of pricing and underwriting. So it's good to mitigate any rate increases in the future, but at the same time, it's causing the initial cost of that coverage to be more expensive and the underwriting to be a little bit tighter. So oftentimes I will look at somebody that they've got a rate increase in their policy that they got 10 years ago or 15 years ago. I'm like, oh my gosh, is there something better in today's market? And I look at their pricing, even with the pricing adjustment, the new premium that's been increased. I said, even with that premium today, if you were back at the age that you originally were when you got this policy, you still can't get the benefits that you have now. I mean, what you've got now is still golden compared to anything on the market today. So they go, oh, okay, well that's good to know. So just lets them know that they didn't make it was still a wise decision when they made that. And for the most part, they still want the coverage because they know how expensive paying for care out of pocket can be.
Yeah,
And just 1 or 2 years of care can have a significant impact on their net
for
worth
sure.
and
It
then
could be
certainly on
hundreds
their
of
family
thousands
as
of
well.
dollars. I mean, it easily not,
Yeah,
and that's not necessarily the exception to the rule. That's,
yeah,
a lot of even assisted living memory care facilities can easily be 10 grand a month. And, that's 120,000 a year of post-tax money. And I think one of the things that's really important, the way to think about this, and maybe you talk about this with your clients too, and I'm just talking from my own personal experience, you think about this insurance, it's really a protection against becoming a major financial burden on your kids
hmm
because that's usually where it falls, right? If the parents need care and they either don't have insurance or they have insufficient insurance but they still need the care, as a family you decide, what are we going to do? Are we going to force a senior into some sort of facility where they're not going to be comfortable at all and they're going to be, I mean, we heard this horrible story once about this older World War I veteran who was basically living in a basement, like, I mean, that just sounds awful. But also none of us want to be a burden on our families. But if you don't have these policies, there's a high likelihood that you're going to be, unless you have a significant net worth, paying hundreds of thousands of dollars for every year of care. And keep in mind, many families are two. It's not just one person, it's two people.
hmm
So, and they don't always need care at the same time, but if they do, you're talking about doubling the expenses, so to speak. So it's significant. Like, this is
It is. And when people contact me about this, and one of the first questions I ask them is, what prompted you to look into this? Why are you suddenly interested in it? And they start sharing a story about being a caregiver and for their mom or for their dad or a loved one. And they just say, it's overwhelming and I can't do this. I never want to put this on my kids. Even if their kids would definitely step into that role, they don't want to. They don't want to put that physical burden on them. They don't want to put that financial burden on them, and oftentimes an emotional burden on them.
right.
And they say, "Gosh, my kids they got their own lives to run and everything, and maybe they're both working, and how are they going to carve out time to take care of me without causing some type of financial hardship or other hardship in their own family?" So they want to make sure that doesn't happen. And so they just want to make sure that they have the liquidity, the cash flow in a policy to be able to have the financial resources to pay for quality care in the setting of their choice. It doesn't mean that their kids aren't going to be involved, but it just doesn't mean their kids have to step in that role of helping them bathe, helping them toilet, helping them. So when a lot of people say, "Oh, I don't want my kids to, I don't want to burden them with this." What do you don't want to burden them with? I just a physical burden? Like, yeah, yeah. I'm like, okay, so tell me which activity of daily living, bathing, dressing, toileting, transferring continents, or eating that you don't want your kids to help you with. All of them. I don't want my daughter
Yeah,
doing any of that for me, you know?
right,
So, and that oftentimes that's a dignity and an independence motive for people. And that's really what they're trying to protect is their independence and their dignity so they don't end up a situation like that because they haven't planned for it.
right.
And even if they have a lot of money, they hate spending it for care.
Yeah, of course. No, because as a senior, you want to be able to pass down your legacy, maybe your home, maybe your investments, whatever it is. You don't want to be bleeding that dry, at 20, $30,000 a month. That will burn through an inheritance pretty
Yeah, it's a
quickly.
pretty heavy burn rate on those assets, and especially if that's retirement funds, qualified money, where they're for every $1,000 of care expense that they need, they've got to pull 13 out of their qualified money to cover that, to net
Right,
that $1,000. So
right,
even though they have a lot of retirement money, that's not a real efficient bucket to pull money out of. What they
right.
like about the long-term care plans is that's all tax-free money that they're able to pull out.
Right.
And
And sometimes the home can be used for that as well. And there's different ways to do that. We handle the financing side for people that want to pay for care, and there's some creative ways to do that.
yeah,
But
with
sometimes we see people actually selling their home, which might make
you could.
sense. But one of the issues that we see often is, and we heard this just horrible story about a woman who needed to pay for care. She was 97 years old, and her family, because they weren't really getting any proper financial advice, were told, oh, let's just sell the house, she doesn't need it anymore. And lo and behold, she had bought the house for $20,000 50 years ago, and now it's worth $4 million. Beautiful, home in an area that wasn't so great maybe 50 years ago, and now it's
Hmm.
a prime neighborhood. And she probably wrote a check to the IRS for $1 million just to be able to sell the home and pay for care. Like, that's more expensive than any premium you're going to pay on a policy, or any loan that you might take out to kind of buy yourself time, because those capital gains usually go away if you sell the home after a senior passes. So
Right, you
make
get the
sure you're
step up,
hiring
but
professionals who can help you with those decisions.
yeah, and as I mentioned, when I take a look at someone's entire financial situation in terms of how to customize how much insurance they might need, because again, I'm a big believer in not over-insuring somebody. I never want to sell them more than they actually need. So someone might be in a situation, say, where they're going to a facility, they can rent that house out, and between the income off the house, some Social Security, maybe they have a pension, and make up that difference with a long-term care policy, they can cover that eight, nine, $10,000 a month expense in a facility, for
Right.
example. You
Yeah,
don't need,
the renting is great, because when you do that, it also opens you up to different loans that you might be able to take out, because it's a rental property where the loan
yeah,
approval is based on the cash flow of the rental only, not on your
not
personal
your
income.
income. Yeah,
Yeah, it's easier to qualify. So that's definitely one of the
yeah,
things. And the other good thing about it is that you can keep that as long as you need it as a rental, right? So it's your care that you're maybe paying for out of the rental income could last indefinitely. So if you need 20 years of care and your rental income is paying for most of it, along with your policy, hopefully,
yeah,
that you've been smart enough to get, you're not going to run out of money, right, with the
yeah,
rental income, because you just keep renting it until it's time to sell.
yeah. I've
So,
seen it where couples have gone to assisted living and they have a property that they're renting out, plus their insurance, plus their other income, and they receive a high quality of care. Or
mhm,
I don't know if certain situations, reverse mortgages might make sense, or RAMs
mhm,
might make sense in a situation. So, but the key is for people to not wait until that event happens, because when it happens, it's usually immediate. And so, it's like any planning, vacation planning or financial planning or tax planning, you want to put something in force. So when that event happens, you have a pretty predictable outcome of how it's going to go, how you want it to go, because you've planned for it. So that's what long-term care planning is all about too, because it's a high likelihood that it's going to happen. It's a more than a 50% chance, as I mentioned earlier, 70% chance. Someone over the age 65, you're going to be dealing with this.
Yeah.
And
And it's going to be a burden financially in a meaningful
yeah,
way. Even if you've done really well over your lifetime, it's still going to be a drain on resources. And I think we all want to leave as
yeah.
much as we can to our families and not burn through money in our late years and not have a legacy to leave.
Even folks that have what we call a high net worth, I work with a lot of them that say, I want to I want to invest for the things that I want to see happen, my lifestyle, my legacy, and everything. And I want to insure for the things that are life's realities. Hopefully, they don't happen, but I want to make sure because it's pennies on the dollar. It's just insurance is just leverage. And that way they can use the money what they saved it for because they didn't save it for long-term care. And a lot of them, I didn't save it so I could give it all. I didn't work 40 years so I can then at the end of my life give it all to assisted living or a nursing home.
Yeah, of course,
So
exactly. That
and
would be
and
devastating.
and so a lot of high net worth individuals oftentimes they look at policies, and these are more hybrid long-term care policies. We don't have the time probably to go into detail about this, but they can go, yeah, I could probably self-insure this. I'm like, okay, you can self-insure this. That's great. How much do you want to self-insure? In other words, what's your stop loss? And it really comes down to, yeah, I'm comfortable paying maybe a year or two of care. I don't want to pay that 10-year dementia event. I don't want to pay that out of pocket. How do we design a policy that maybe I can just insure the first, year or two? That's on me, but just put the catastrophic or that tail risk onto the insurance company. And there's ways to design policies that do that. So again, it's just really understanding what's important to them, what their needs are, and then how do we customize something that's really going to fit their specific situation.
And I think our conversation is, if anything, it's taught me that the customization is really where the secret sauce is, as
Yeah,
far as like trying to make it work for people within their budget, but also looking at, how long do you want to plan for, what type of policy is right for you. There's a lot that goes into that.
yeah, and that's
So
why
I
you
can
work with
appreciate it
someone.
better now thanks to you.
Yeah, someone like me who is really specializes in long-term care. This is our lane. This is what we do,
Right.
and so
Great. Well, one thing you mentioned that I wanted to ask you about also, you mentioned that there's a difference in cost between men and women. So I want to hear more about that real quick.
so when you're designing a long-term care policy, and say you have a traditional long-term care policy, and you're just that annual premium or that monthly premium is going to be more expensive for women than it is for men. Say the same age and same health, the women are going to be it's going to be more expensive. And the reason for that is just higher utilization. They use these policies for longer, they use more policies more often for longer periods of time than men do. So
Is that
without
based on statistics and
it's
data
based
or
on kind of culturally what happens or with just normal lifespans what happens. So oftentimes what you have is say with a married couple, more often than not, especially if the husband is older, the one spouse is older, they're going to predecease their wives, and the wives are going to live longer. And so that husband may have needed a couple years of care, maybe a little bit of care, and the wife is able to take care of him. Now, when she needs care, she's taking care of everybody else. And now when she needs care, who's there for her? Might not have that same support group available for her. So using their long-term care policies more often and for more benefits and for longer durations than men. That's not always the case, but more often than not, probably about 60% of the time, the women are the caregivers. It's that gap is kind of closing, but that's kind of where it is. And they live longer. So just like life insurance is more expensive for men because we have a shorter life expectancy, long-term care is more expensive for women because they have a longer life expectancy. And the older they are, the more likelihood, the longer they live, the more likely they're going to use their policy.
so if you have all the appropriate policies that evens out between men and women eventually, right? You either get hit with more expensive life
Yeah,
insurance or more expensive LTC
yeah.
coverage.
Yeah, and again, so much of what I'm talking about is just very general until we get into specific scenarios. Then we're and certain policy types in terms of where's that premium difference really falling and how much. What is
Right.
the discrepancy? And that really depends on what carrier it is, what policy structure is it, things like that.
Right. And that's where you come to an expert like you who knows what carriers to go to for what types of policies if people are trying to
Yeah.
navigate this on their own. Same thing with mortgage financing. You try to navigate on your own, you're probably barking up the wrong tree more likely than not.
Yeah. One thing that's really critical, because you mentioned something with aging, and I think I responded with the older you get, the fewer options that you have. One thing that I bring up quite a bit to home care agencies or facilities is, and even financial planners, is they may have clients that are in their late 70s or even in their early 80s, and they haven't done anything about long-term care planning yet. Now they're going, our health is not as great as it was when we were 70, and what can they do? And so if they're in a situation where they have say they have an existing annuity, non-qualified annuity in their financial portfolio, and uh, and they don't have cancer, they don't have Parkinson's disease, they don't have dementia, and they don't need home care, they don't need help with their activities of daily living. You can do and maybe they got this annuity 20 years ago, 30 years ago, and it's got all this deferred gain, all this taxable gain in that policy. Oftentimes we'll just do a 1035 exchange. We're going to switch that policy into a policy that has long-term care benefits. You're still going to have your money in that policy is still in that annuity contract is still liquid. It's still growing tax deferred. It's still available to you. But if you need care, you can pull that money out free of income tax to pay for your care. So I've had people in a situation where they can't qualify for regular long-term care insurance, but they had this annuity that uh, had had one guy, had an annuity, it has like $200,000 in it, but he bought it a single premium of 40,000. So that $160,000 difference is taxable gain. We put that into a long-term care annuity. It still grew to close to 300,000. When he needed care, he was able to pull all that money out free of income tax to pay for his care. So there's strategies like that that we can look at. It's doing the same thing with using cash value in an existing life insurance policy to put it into one of those policies for someone who's older with health conditions. That's a good solution for them because we've created a non-taxable bucket that they can use to pay for their care. So there's so many different options out there. And
Yeah.
even in other states outside of California, there are policies called short-term care policies, which even people that are older or have some chronic conditions can still qualify for and get a certain amount of coverage available to them, paid out, more money paid out to them in a shorter duration to cover home care, to cover facility care. And those are great solutions too.
Yeah.
So
Wow.
um,
There's a
I could
lot.
overwhelm you with the different options that we have, but
No, I mean it's great. I think just even mentioning them lets people know like they need to come to an expert like you to navigate this. It's just there's way too much, and as they say, you don't know what you don't know, and you could take
yeah,
many missteps or get the wrong type of policy or get one where you're going to be using taxable money when you pull it out rather than non-taxable. There's so much to it, and taxes are a big deal in real
yeah,
estate and insurance and everything else. You don't want to be paying taxes every time you need to pull a dollar out of your wallet, so to speak. So,
right, right.
but Brad, I really appreciate you sharing your insight with our group and our network, and you've provided just. I'm gonna run out and get more insurance after this.
I know a guy.
You know a guy. All right, all right. We'll talk offline. But I do appreciate you spending the time to educate
My
people.
pleasure.
Something that's dear to our heart is education and making sure that people are making informed decisions. Whatever decisions they make, at least you know what the implications are both ways. So I appreciate it. And if people want to reach out to you to have you do a collaboration to see if policy might be right for them, what's the best way for them to reach you?
Email is typically the best for me. Is My email is Brad at Tisdale ins.com. So that's my first name, Brad, at my last name, and then ins. That's just short for insurance.com.
Perfect.
And
All
or
right.
they
Well, I
can.
hope lots of people reach out to you.
Okay, sounds all righty, Mark. Appreciate the time. Always
All
good to see
right.
you.
Thank you. Thank you for joining us. And thank you to our audience today for joining this episode of the On the Mark podcast and financial forum. We will see you again next time. Have a great day.